Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, Eitel.
All right. Hey guys, my name is Mark Eitel and you are tuned into the Mr. Mortgage Show. And sit tight because you landed in the right place at the right time on the right day, because we have an awesome show lined up for you today. We are going to talk about some things that I am not hearing in our space when it comes to evaluating the cost of money, how to calculate effective interest rate. We're going to dive into all of that, and it stems from a recent series that I've been doing. I've been talking on the cost of money and how to evaluate when it makes sense to pull the trigger on new debt from a mortgage standpoint. Anyway, guys, we're going to dive into that in a second. But as always, I encourage your questions and comments. You can get those to us by calling or texting 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen is womanning the hotline, and she will get your questions on the air. If you prefer to shoot her an email, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions to her that way. She'll be happy to read them on the air. But hey, guys, as I mentioned, I've been doing this new, I don't want to say lecture series because that makes me sound like I think I'm Jordan Peterson or something. And man, is that guy not fascinating or what? I've been doing talks on evaluating the cost of capital and how it relates to cash flow, because a lot of people right now in today's market are getting tripped up on this super low interest rate that they have. And guys, we will never, ever in our lifetimes see interest rates where they just recently came from. I mean, we did a 15-year mortgage at 1.92, I think, when we were in the height of the refi boom. Just fascinating to me that money was costing less than 2%, and that's the Fed's target inflation rate, which we are far from 2%, but that means the money is free, essentially, at that point. It's costing the lender that money because it's not outpacing inflation. So guys, we are never, ever going to get back to where we came from. And because of that, people are making decisions based on a vanity metrics. They don't want to give that up. They're so very married to it. And I'm not encouraging you to do it. I'm not encouraging you to give it up unless it makes sense. We own a home with a super low interest rate on it, and we're going to buy another home. Well, we're not going to sell that house because we will never own a rental property with that low of an interest rate and that low of a monthly payment against the amount of equity that we have in it. So I'm not suggesting that sacrificing that super low rate makes sense in all scenarios, but in a lot of scenarios it does. And I'm hoping that shedding light on the true cost of money can help people make a better decision, because standing around the barbecue and bragging about your 1.93% 15-year mortgage, that's not helping you when you're at home and you're at the table and you're struggling and you're frustrated to figure out what bills are getting paid first because your home equity line of credit payments gone up, because your credit card payments are going up, because you can't refinance your cars because you're upside down. You bought them at the height of the pandemic and you overpaid for them and now you're stuck. So right now today, the average credit card is over 21%. And these numbers come from Bankrate and NerdWallet. I did the research before we jumped on the air. This isn't my data. Average credit cards are over, I think over 22%, let's call it over 21%. HELOCs, home equity lines of credit, are averaging between 8.5 and 10.5, some even higher. Guys, 2 years ago, they were practically giving that money away, but every time the Fed moves the overnight rate, the prime rate, these rates move also. And I found this fascinating. Car loans, as per bankrate.com, are averaging between 9 and 17%. That is expensive money. 6.5% at 30 years on a piece of property suddenly sounds like cheap money. But here's where a lot of people don't fully calculate the benefit of using the proceeds cashed out of their property to pay off debt. So bear with me while I set this up. The average salary in this country today is $55,000, which, man, no wonder a lot of people are struggling buying a house. That's astonishing to me. But the taxes, federal taxes, not state income tax, federal taxes on $55,000 puts you in a tax bracket of around 22%. These numbers came straight off the IRS website. So at $55,000, you're going to be paying $12,000 in taxes. Well, guys, cashed out proceeds from a refinance are tax-free. That means every $10,000 that you take out spends like $12,200. So you can pay off $12,200 worth of debt with $10,000 if you look at it that way from a true cost of money. So a lot of people don't realize that. Your spending power of borrowed. Robert Kiyosaki says it all the time. I pay no taxes because it's all debt. Guys, surf the internet. That's a super, super interesting talk. So right off the bat, you're saving the federal tax rate of 22%. That money is far cheaper than people are calculating it because they're not paying federal taxes on it. So what's it really worth? What's the real value? Is it that savings in the federal taxes, that additional spending power, or is it the accumulation of all the debt that you've paid off and the monthly savings? Now here, take it one step farther. We're seeing people save several hundred and in some cases a couple $1,000s a month. What could you do with that couple $1,000s a month? Could you quickly build up a savings account? Because everybody needs an FU account. Everybody. We need 6 to 12 months in case of an emergency. Well, an interesting data set I read the other day said the average American could not absorb a $1,000 unexpected expense. That's heartbreaking to me. When people are sitting on a bank of equity that they did zero to earn. They weren't savvy investors that made all of these hard decisions. We're the lucky homeowners club. We bought at the right time. Properties have appreciated to a point that none of us anticipated. We have all of this newfound equity. Where is it best used? In some cases, it's best used banked in the house. I mentioned that. Don't touch it. Don't touch it. That's awesome. It's safe there. But if you think in the future your circumstances are going to change, and a lot of people do, a lot of people are really freaked out by where this economy is going, then having some money in the bank and having your debts reduced to the lowest amount of monthly expenditures, because that equity doesn't buy groceries, cash flow does. So if you can save that money each month, so you have more money at the grocery store, does that make sense? So guys, I just want to encourage people to look at the true cost of the money and the true net savings in making the decision, because yes, it sucks to have to give up that super low interest rate. You don't get to brag about that at the barbecue anymore, but paying off those cars that are upside down, knocking out that Visa credit card that's 20 some odd % interest rate, or paying off that HELOC that suddenly jumped to 10.5%. Is that savings going to make a big enough difference in your life to justify the expense? And could you build up a rainy day account much quicker by having that additional cash flow each month? And then, guys, we haven't even talked about this. You want to control your effective rate of interest, your true cost of money? Start prepaying principal. Not only will you pay your loan off faster, you'll reduce your cost of money significantly. You could turn 6 into 3 in a hurry that way. But guys, you hear the music? That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And guys, I hope you are ready. I hope you're wound up. Man, I really appreciate you letting me rant a little bit in that opening segment, because I just think we need to stop making decisions with emotion and ego and start using data and logic, because it's much, much more beneficial in the long run. You're going to come out on top. But if you have questions and you want to get them in this week's show, just call or text 855-462-7292. That's 855-462-7292. That's the Anytime Hotline. Or head on over to mrmortgageradio.com, scroll to the bottom of the page, click that email icon, and you can send your questions to Jen that way. But guys, I'm wound for sound. I am highly caffeinated, super excited to be with you. So let's dive right into some of these questions. Hey, Jen, throw me question number one.
Courtney sent us this. We've been helping my father financially, but things are getting tough. I'm thinking it may be time to discuss a reverse mortgage. How exactly does the repayment work with a reverse mortgage? Can we get stuck owing a bunch of money when my father dies?
Hey, wow, Jen, that was very dramatic. Did anyone else catch that, how she set that up? I think it's time to discuss a reverse mortgage. Dun, dun, dun. It sounded like a drama series on TV. Hey, great question, Courtney. No, I'm kidding. Jen's giving me the stink eye, guys. I think I'm in trouble. To answer your question, Courtney, no, you won't get stuck with a bunch of debt. Now, you will have to pay the loan off when your father passes. So it's like any other mortgage. It has to be paid at the transfer of deed. So once he passes, or if he moves into assisted living full time and he's no longer occupying the property and you sell it, that mortgage gets paid off. But if your fear is that over time, he could accumulate so much debt against the property that he's in a negative equity position, meaning he owes more than it's worth, that's not going to impact you. The reverse mortgage is part of the FHA loan portfolio, if you will, the catalog of products. So it's insured. It's a federally insured loan program, and you just slide the keys across to the bank. The bank sells the property. They incur the loss, and later they cash that insurance policy to get a portion of those proceeds back. So it does not negatively impact you if he should owe more than it's worth when you inherit the property. I hope that makes sense. And guys, a lot of people have that question. It's a non-recourse loan. You can give the keys to the bank. You have a year to settle the estate also. That's another big one. How long do we have to pay that off? What's going to happen? They give you adequate time to settle the estate because the industry knows that that's usually the end of life loan, right? That's the last loan the people are going to get. So it's set up that way intentionally to give you time to settle the estate, and then also that insurance component makes it non-recourse to you as an heir. So brilliant question. I appreciate that. And we are talking to more people about what we opened the show up with, debt consolidation loans, and then also a lot of people are leaning into the reverse mortgage because equity is all they have right now. That Social Security increase wasn't enough. And man, it's just so much more expensive to live today than it was, as recently as 3 or 4 years ago. Homeowners insurance, the groceries, the fuel, the healthcare, everything, these everyday expenses that the fixed income senior just can't avoid. The equity is usually what they have to lean on. So we're talking to more people about it. Courtney, if you need more info, reach out. I'll be happy to send you the reverse booklet. If anybody wants to request it, go to mrmortgageradio.com and click on that more about reverse link. But I appreciate that. Hey, Jen, throw me another question.
Nikki is asking, how will refinancing my mortgage for debt consolidation affect my credit score? If we pay off all our credit cards and close the accounts, our score should go up, right?
Hey, that's a great question. They will go up, but as long as you don't close those accounts out, because length of credit is one of the criteria that are factored into scoring. So a lot of people make that mistake and they'll pay the debts off and then close the cards. And then now they don't have any old established credit lines. And then what's left on their credit is usually utilized more. So if you close out all your old credit cards and you've got one that's at, 50 or 60% utilization, meaning you've borrowed 50 or 60% of the available credit, that's also a scoring criteria. So if you've got 10 cards that have a $500 available balance, you've got $5,000 in available credit. Well, if you close 9 of them out and you owe $250 on one, now you've used 50% of $500. So length of credit is a scoring criteria, and the amount of credit utilized against availability is also a scoring criteria. And by closing out those old accounts, even if you're not using them, keep them open. So that will help your credit score immensely. Paying them off and leaving them open, yes, will increase your credit score. But brilliant question. I hope that helps. If anybody gets confused about that, just reach out. I'll be happy to walk you through it. Hey, Jen, can you throw me another question?
Randy sent us an email. This may be hard to follow, but can I buy an LLC that owns a rental property instead of buying the property? I'm thinking this will save on a big tax increase. I'll also inherit the lower interest rate. I'm trying to think outside the box.
Hey, Randy, that's a great question. You might be thinking a little too far outside the box when it comes to the tax savings component, though, because commercial property or residential rental property, so anything that's not a primary residence, the taxable value is reassessed annually. So if your thought is that you're buying a property that has a lower tax base, it's unlikely that it's going to stay that way because it gets assessed annually. And that's one of the advantages of homestead exemption on primary residences. That increase is capped. So from that standpoint, and I guess I need to back up. I'm not a tax attorney, but that's one thing I see that's flawed in this calculation. I don't know that the tax savings is going to be there to the point that you're considering it to be as a buyer. And I believe that the seller will also have a taxable event by selling the LLC. Now, you inheriting a lower interest rate, that's where it gets interesting and attractive. Assuming that the loan was closed in the name of the LLC and that the original LLC owners are not personal guarantors, then this might work. It might be a way that allows you to take over that loan that is currently on the property under the terms that it currently exists, because if XYZ LLC is the owner and the borrower and that doesn't change, then in theory this could work. But I would love to have a conversation with you and understand it in a little more detail. Because I'm missing a lot of details that I would need to have a full comprehension of this. And secondly, I am not a tax attorney. I don't play one on TV. I didn't sleep at a Motel 6 last night or whatever that motel commercial used to be. So I don't want to pretend to understand all the tax implications around it. But I do know where you're going, and I think some of it has merit. So interesting concept, and I commend you for thinking outside the box. Now, I know I didn't fully answer that question, but I would welcome the opportunity to have a deeper conversation with you about it. But hey, you hear the music, you know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And we've had some great questions so far. Man, let's keep them coming. If you have questions or comments, 855-462-7292. That's the Anytime Hotline, 855-462-7292. Jen is womanning the hotline, and she will get you on the air. If you prefer to shoot us over an email, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page. page, click that email icon, and you can shoot your questions over to Jen that way. And if you ever miss something on the show and you didn't jot down a link or a website or a data set, or you want more, check out MrMortgageRadio.com. There's links to everything, and then we post all of the data to the Facebook page. And you can find that at Mr. Mortgage Radio as well. Just click on that Facebook link. So I just wanted to throw that out there because we move fast, and sometimes I feel like we don't do a great job of directing you to additional info, and you can find it there. But hey, speaking of moving fast, let's move fast through a few more questions. I really think we've had some good ones so far. Let's see what's up next. Go ahead, Jen.
Glenda sent this. Are there any negative tax implications to consider when doing a cash-out refinance? Is the money treated as income?
Hey, Glenda, that's a great question. And that's what I was alluding to in that opening segment. No, it's not income. It's debt, right? And that's what I love about, Robert Kiyosaki when he starts talking about how he owns all this real estate and he'll finance the real estate to make other purchases because it's debt. The proceeds from that transaction, from that in his case, he was talking about refinances. He pulls cash out of a property. And I guess, Glenda, you're talking about the same thing. That's tax-free. And we talked about it in the opening segment. A lot of people are looking only at the interest rate, right, as the cost of money, which I totally get it. That's the logical place to start. But it's not the logical place to stop because we threw some statistics out opening the show up today that the average American makes $55,000 and puts them in about a 22% tax bracket. So using that 22%, every $10,000 you borrow in the form of cash out funds is spending 22% stronger, if you will. It's got 22% more spending power. And that's what a lot of people miss. If you're going to pay off debt with earned income, and you're in that $55,000 range, right? You would have to earn $12,200 to have the 10 grand left over to pay off that $10,000 debt. But if you borrowed $10,000, you're getting it tax-free, and then you can use all of it to pay off that debt. So I hope that helps. That was a little bit of a long answer to your question, but the easy, short answer is no, it's not treated as income because it's debt. So hope that makes sense. If you need more info, you know how to reach us. Hey, Jen, do you have another question ready? Okay, go ahead.
Thomas is asking, we've been waiting for months to pull the trigger on a rec refi hoping rates are coming down, but that doesn't seem to be happening. If we refi now, can we refi again next year if the rates finally do come down?
Hey, this is a great, great question. Brother, I appreciate you sending this one in because a lot of people are asking us this daily in our practice. Yes, you can. You absolutely can. But you may not need to. And if you can avoid it, you certainly want to avoid it because you have a whole set of closing costs all over again. And even with us, we've created what we call a strategic refinance. And we did that last year when rates first touched 7 because a lot of people wanted to buy, but they wanted to know they had a cost-effective strategy for refinancing in the future. So we created the strategic refi program so somebody can refinance in a relatively short period of time and save some of the fees associated with doing so. But we have found that using things like the rate buy-down strategy are positioning you to most likely not need to do it as soon as you would think. So let's just use round numbers, right? Let's say the rate of the day today is in the high 6s. Pick a number, 6.75. And you can do a rec refinance and use a little bit of your equity that you've built up, the house's money, if you will, right? This newfound equity wealth, to buy the rate down to, let's say, 5.75%. And let's say rates stay here for 2 years, 3 years, 4 years. I mean, you look at a chart and you could argue that it's going to be here for a little while. You can certainly argue that we're going to be back down around 5. But where would rates have to go before you wanted to refinance that 5.75? Would it have to be 4.75? And then that starts a whole nother conversation because What is it going to take for rates to go to 4.75? And if you're out there holding on to the fantasy, and I didn't mean for that to sound like a derogatory comment, but there are people out there holding on to this idea that rates are going to come back down to the 3s or 4s. Guys, you do not want to live through what it would take, the calamity, the economic calamity that it would take for rates to get back down to the 3s and 4s. You don't want to do it. Think about what it took for them to get there the first time. So I share all of that to say that there are strategies that you could put in place today. Save yourself that second set of closing costs, buy your rate down now, and position yourself to win today, tomorrow, and in the near-term future, regardless of what happens with rates. Let's say you buy it down to 5.75 and rates go to 8. Woo, you won. You're way ahead of the game. And if they go to 8, how long is it going to take them to go to 4? And would a move from 5.75 to 4 justify a refi at that point? If it's 15 years in, it might not make sense. So these are conversations I love to have around the evaluation of doing this. But to answer your question, yes, you could do a back-to-back refi strategy. I would like to talk to you about putting a strategy in place, though, that would allow you to win today so that you did not necessarily have to jump right back into another refi. Just saying, because even with the strategic refinance, there are costs associated that you can't avoid. So it's not as simple as just knocking on the door a second time and getting a better interest rate. I hope that helps. And I don't mean to imply that you're holding on to this fanciful whim of some super low interest rate. These are just things I hear every day from realtors, from people who are on the fence about making a decision, and they saw somebody on TikTok or they saw somebody on YouTube saying, rates have to go back down. Well, rates don't have to do anything. At the end of 2021, that we projected interest rates were going to go somewhere around 6%. Everybody told me I was crazy. Stop drinking, Mark. What are you smoking, Mark? Well, rates went up to 7%, and those people were saying that rates were going to stop under 4. Well, those very same people said we were going to be in the 5% range by the end of Q1 of this year. Well, where are we, guys? And I'm not saying I'm Nostradamus. I use the data, not the emotion. I'm not trying to tell people what I think they want to hear. I'm telling them what I believe. So anyway, I hope that helps. I appreciate the question for sure. And I personally believe in almost any interest rate environment, there are real estate strategies that make sense. So, man, I appreciate that question. Guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. And guys, we're going to jump right back into your questions. But if you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is standing by, womanning the hotline, and she will get your questions on the air. If you prefer email, check out MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot her your questions that way. But without further ado, let's throw it over to Jen for another question. I think I know which one's coming because I was peeking at the screen.
This one has no name. Can I buy a property now without my spouse finding out and later refinance and move into it as my primary home? I'm anticipating a divorce soon and want to be ready. Anonymous.
Do you think Anonymous is a man or a woman?
I'm thinking it's a woman that wants to get away from her man.
Yeah, I do too, because men, we're just not that smart.
They're not that calculating.
Not that calculating at all. We're the big dummies in the relationship. So, Miss or Mr. Anonymous, I don't mean to typecast you. I just think women are smarter than men. But anyway, yeah, so this is an interesting question. I am not prepared to answer it because I'm not an attorney. I don't know that you're going to hide it from the court and that you're going to hide it from the attorney. In theory, you could go out and buy the property and get yourself set up, but you might have to fight for half the value of it when you get divorced. Just to finish that thought out for a minute, assuming that you qualify with just your income and with just your assets, you could buy the property by yourself and deed it in your name alone. But I don't know that the goal is going to be accomplished if you don't want to fight for it. If you want to get it set up and you're okay fighting for it, then you could do that. But anyway, not a divorce attorney and don't want to give you the wrong advice. I would definitely seek the counsel of a divorce attorney just to walk them through that. I don't want to make any assumptions, and I don't know what state you're in, so I don't even want to speak to the states that I'm familiar with as far as how that works. So, but in theory, you could feather your nest, if you will, and be ready to make a move to a property that you own. I just think it may come into play as part of the marital settlement agreement. But interesting question, and I certainly appreciate you for sharing it with us. I found it fascinating, and I understand why it was signed anonymous. Hey, Jen, throw me another question.
Ed sent us an email. I like what you've been saying about using an interest rate buy down. I like the idea of asking the seller to pay for it even better. But how much do we need to ask for them to pay for it? How low can we buy it down?
Hey, Ed, that's a great question. And you know what? We don't ever talk about that, do we? So I apologize because that's a cliffhanger, if you will. So there's no hard and fast rule of thumb because pricing for everything in the mortgage world adjusts daily, sometimes multiple times a day. But a pretty good rule of thumb is 3 to 4 points, which is 1% of the loan. So if you're buying a $250,000 house and you're putting $50,000 down and you're taking a $200,000 mortgage, 3 points would be $6,000. So between 3 and 4 points on any given day will typically buy the rate down a full percentage point, maybe a little bit more, but that's a permanent rate buy down for the entire term of the loan. So to play that out, if you could get a seller contribution on that example of somewhere between, $6,000 and $8,000, which on a $250,000 purchase is not uncommon, that's usually enough money to move the needle a full percentage point. So I hope that helps. Now, the other side of that question, how far you can buy the rate down, that's a very complicated question. I would encourage you to give us a shout. Let's talk that one through off the air. And the reason is it depends on how the fee structure for the buy down is set up on the front end of the loan, because there's not a cap on how far you can buy it down. There is a point of diminishing return. You'll see that it quickly costs more than it's worth to buy the rate down beyond a certain point. But why I reference the fee structure is, since the lending guidelines were changed and the new laws were put in place post the crash, there are limits on what you can pay as a total bucket of fees and still be in compliance with the lending laws, if you will. So that's usually where that number is exceeded before you get to a point that you can't buy the rate down anymore. And I know it's confusing, so that's why I would want to have a little more information so I'm not giving you bad answer, if you will. But to answer the first part of your question, somewhere around 3 to 4% of the loan amount, not the purchase price, will buy the rate down comfortably a full percentage point, maybe a bit more for the life of the loan. So brilliant question. I appreciate that one. Hey, Jen, let's try to squeeze in a couple more. What do you have?
Brenda sent a text. My husband and I want to help our son buy a home. We'd like to give him a down payment, but can we use our equity line for this gift? I read online you can't use borrowed funds for a down payment.
Hey, Brenda, that's an easy one. Yes, you can. The whole borrowed funds thing is for the borrower themselves. If they were borrowing money from Uncle Vinny and they were going to have to pay that debt and they weren't disclosing it, that would have to factor into their debt to income ratio. And then they may not meet the requirements for saved money because it has to be seasoned a certain number of months before it's quote unquote a down payment. But when it's gift funds, then it's not borrowed money in your son's world. It's borrowed money in your world, and you can borrow money from whoever you want to give it to your son. So absolutely, you can use your equity line to gift the down payment to your son, and people do it every day. That's a big place. People are leaning in on the newfound equity to help create opportunities for their kids. Great question. Hey, let's keep going, Jen. What do we have?
Natalie sent us this one. Can I use a landlord loan to buy a fourplex and move into one of the apartments? I'm looking for a no-income option and thought this might work.
Hey, Natalie, that won't work. Landlord loan is only for investment property. There's a disclosure in there that states you will not occupy it as your primary, but I would encourage you to look at an FHA loan with a down payment assistance grant because you could get 100%. Oh, wait a minute. You said no income verification. Sorry. I was thinking the down payment side. There are no income verification loans available. They usually require a larger down payment. And in that instance, it would work as long as you could meet that down payment requirement. So, Jen, let's squeeze in one more.
Bert is asking, I just went to your website and requested the reverse mortgage book, but a friend told me I'll need to increase my insurance on the house if I do this. Is this true? I only have liability insurance now.
Hey, Bert, that may be true. And yes, you're going to need dwelling insurance for sure because it's a mortgage and the mortgage is going to require that you carry enough insurance to cover the full replacement cost of the property or the loan amount, whichever is less. And oftentimes it's the full replacement cost. And if you are only carrying liability insurance, I can almost guarantee that you're going to get a policy increase, unless you have a load of liability that you can reduce to offset the premium. But man, that is a brilliant question. Insurance needs to be evaluated as part of the reverse mortgage process. But guys, you hear the music, you know what that means? Man, oh man, we have wrapped up another week here at the Mr. Mortgage Show. Guys, if we've left any questions unanswered, if we've sparked conversations that you want to continue, check out MrMortgageRadio.com. That's MrMortgageRadio.com. All our contact information is there. Yes, Jen and I will be back next week right here, same bat time, same bat station. But you do not have to wait a full week if you want to continue a conversation. Just reach out. We are here and always happy to help. Jen is wrangling me out of the studio. We've got to run. Guys, we'll see you next week right here, same time, same station. Have an amazing week. Until next time, be good. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to MrMortgageRadio.com. That's MrMortgageRadio.com. click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.